Gold is trading at all-time highs. So the real question isn't whether gold was a good investment. The question is what usually happens next, after gold breaks into record territory. History gives us a very consistent pattern. After all-time highs, gold often becomes volatile. Corrections of 15 to 30% are common, even during strong bull markets, and in some cycles, drawdowns have been much deeper. That doesn't automatically mean the trend is broken. It means the market is transitioning from a breakout phase to a digestion phase. Prices pause. They chop sideways. And weak hands get shaken out. This is where many investors make a mistake. They see headlines about record highs and assume it must be either a guaranteed buy or an immediate top. But gold rarely behaves in extremes. It usually moves in cycles. Now, here's the key point for 2026. Who is buying today is different from past decades. Modern central banks have been structural buyers of gold. They don't buy because of weekly price action. They buy because of reserve diversification, long-term risk management, and geopolitical considerations. That means they may slow down at record highs, but they often don't flip into large coordinated selling. In many cases, they pause, then resume. That creates a form of underlying demand. Even though it does not eliminate pullbacks, institutional investors behave differently. They often buy strength during breakouts. But once moves become extended, they tend to trim, rebalance, or wait for pullbacks to re-enter. So even in a bullish macro environment, gold can fall sharply. That's not a contradiction. That's the difference between structural buyers and tactical buyers. So what does this mean for you? It means buying exactly at an all-time high can produce poor short-term results. You may face drawdowns or long periods where nothing happens. But over a full cycle, if the macro forces remain supportive, those highs have often turned out to be waypoints, not final tops. The right approach at record highs is not prediction. It's positioning. Time horizon matters. Position sizing matters. And expectations matter. Gold at all-time highs is not a signal. It's a phase. A phase where patience matters more than headlines. And where understanding who is buying and why matters more than the price itself. If you want, in the next video, we'll break down the key macro signals that typically decide whether gold consolidates or starts the next leg higher.